Someone applies for a premium travel card. Good job, solid salary, six figures. They figure approval is basically a formality. They make good money, they pay their bills, they're not some financial disaster. They submit the application and get a denial. Not a pending review, a denials. And they're sitting there thinking, I make real money. What exactly is the bank seeing that I'm not? That's the real question. And most people who have been in that situation never get a clear answer to it, because they keep focusing on the one thing they're confident about, the income, instead of looking at everything else in the file that the issuer actually evaluated. Here's the belief most people are operating on. High income means low risk. Low risk means easy approval. So if you earn well, approval should follow almost automatically. Any denial must be a mistake, or an overcautious algorithm, or bad luck. That sounds logical, it isn't enough. Banks are not primarily asking whether you can afford the bill. They're asking something more specific. Based on everything in your credit file right now, are you the kind of applicant we want to extend credit to? Those two questions don't always have the same answer. And people who confuse them are the ones who end up surprised when a solid salary doesn't save a weak application. Here's the mistake. Most people think about credit approval like a conversation, like they're sitting across from someone at a bank, explaining their situation, making their case, and letting the income do the heavy lifting. In that version of things, the salary is the main argument, and a strong salary is a strong argument. That's not what's happening. When you apply for a credit card, you're not making a case. You're submitting a file. That file gets evaluated against specific criteria. The issuer is not considering your general impressiveness as a person. It's looking at the signals in your credit report and application data, running them through an underwriting model, and producing a decision. Your confidence about your own financial situation is not in the file. Your conviction that you're reliable is not in the file. What's in the file is a score, a history, recent inquiry activity, open balances, utilization ratios, account age, and the income figure you reported. Those inputs either produce an approval or they don't. And if several of them are weak, the income number does not single-handedly override the rest. Banks do not approve income in isolation, they approve files. Let's go through what's actually in the file, because this is where the surprise denials get explained. Credit score is the most obvious factor. But score works differently than people expect. A 720 is solid for a lot of cards. For a premium card, the kind with a $500 annual fee, airport lounge access, and a substantial sign-up bonus, the typical approval range often starts in the 740s or higher. A high earner with a 715 may get denied for a card that someone making less, but scoring 760 gets approved for. The score is doing more of the filtering than the salary. Most people don't account for that gap. Credit history is separate from score and matters in its own right. Not the number, the depth, how many accounts. How long have they been opens? What does the payment pattern look like across all of them? A high earner who's relatively new to credit, maybe they came from another country or spent years as a student who didn't build credit aggressively, can have a thin file. Not a bad file, just not enough file for the lender to feel confident. Income doesn't fill in what's missing. It sits alongside the gap. A thin file with a big income is still a thin file. Recent applications matter more than people realize. Every credit card application creates a hard inquiry on your report. Individually, one inquiry isn't much. But 5 in 12 months tells a story. It suggests someone who's been actively trying to access credit, and regardless of why, that pattern is visible to the next issuer who pulls the file. A high earner who's been chasing sign-up bonuses or rebuilding a portfolio can walk into a premium card application with an inquiry count that signals something the salary doesn't cancel out. Utilization is one of the most underappreciated factors. This is the percentage of your available revolving credit that you're currently using. Someone with a $20,000 credit limit, carrying $16,000 in balances, has 80% utilization. That's a serious flag regardless of what they make. A high earner who charges everything and pays minimums, or who carries balances month to month even while technically managing it, can show utilization that looks like strain in the data. The income might say comfortable. The utilization is saying something else. The model weighs both. Debt to income is real too. This isn't just credit card balances. It includes mortgage, car loans, student debt, any monthly obligation. A six-figure income is only impressive relative to the obligations stacked against it. Someone making $180,000 with a heavy mortgage, an expensive car payment, and significant student loans may have a debt-to-income profile that looks tighter than someone making $90,000 with minimal obligations. Income is a number. What matters is what's left after everything it's already committed to. And the profile has to be internally consistent. A high income sitting on top of a thin history, recent inquiry spikes, and high utilization raises questions. A lower income applicant with years of well-managed accounts and clean utilization can look more predictable to the same model. The pieces have to fit together. A salary that doesn't match the surrounding credit behavior creates friction in the evaluation. Here's the harder truth: a strong salary can sit on top of a weak file. And the file doesn't know how hard you work to earn that salary, or where your career is headed, or what your financial trajectory looks like from your own perspective. It knows what's been recorded. And what's been recorded is either approval ready or it isn't. A lot of people with money still think lenders are approving confidence. They're not, they're approving data. The specific frustration that hits high earners is often about a gap between how they see themselves financially and what the file is actually showing. Someone who earns well tends to feel financially stable, and they probably are in real life. But credit files are backward-looking, they show what happened. They don't show what will happen. Someone who is in a strong place now but had a rough stretch a few years ago, high utilization during a transition, a period where spending outpaced payments, still has those signals in the file. The income is current, the file includes the past. And the model evaluates the whole picture, not just the most recent chapter. You're not being judged as a person. You're being judged as an application. If the application is weaker than you think, the salary won't fix it. There's something specific happening with premium cards that's worth understanding. A high-end rewards card isn't just looking for someone who can afford it. It's looking for a creditworthiness profile that justifies the risk. The issuer is extending $25,000 or $30,000 in credit while offering upfront value worth hundreds of dollars. That's a meaningful bet. The bar is higher because the exposure is higher. A high-income applicant can still look inconsistent, aggressive on applications, or badly timed. A file showing recent inquiry spikes, elevated utilization, and limited history doesn't stop being that file because there's a strong salary attached to it. The premium product is designed for applicants whose whole file communicates stability, not just applicants who feel stable. If you got denied, the denial letter has reason codes. Federal law requires issuers to provide them. Most people look at the letter and file it away. That's a mistake. Those codes are the specific answer to what was weak in this file. Read them, they're direct. They'll say something about recent inquiries, or the proportion of revolving balances, or credit history length, or the score threshold. Each one points to something fixable, or at least something with a clear path. Too many recent inquiries, stop applying for a while, inquiries age off. A clean 12-month window can meaningfully change how the next application looks. High utilization, pay down balances before applying again. Utilization is one of the fastest-moving factors in credit scoring. It responds to payment behavior within a billing cycle or two. Someone at 75% utilization who gets to 15% before applying looks very different to the same model. Thin history, there's no workaround, time is the fix. Add an account at a lower tier, manage it well for a year, let the existing accounts age. Then come back for the premium product. Negative payment history, longer timeline. The focus is on building clean positive history that gradually outweighs the older marks. It takes time, applying again sooner doesn't help. One more thing, check whether the card matches the current profile. Premium cards have typical approval profiles. If your file is marginal for that product, pairing it with an income that's at the lower end of usual approvals isn't going to produce a different result. Starting with a product that fits the current file, building a solid track record there, and then moving to the premium tier is more reliable than repeatedly applying for something the file isn't ready to support. Let's be direct about the income point one more time. A high income is a genuine positive factor. Issuers collect it, they weight it, it matters. This isn't an argument that income is irrelevant. It's an argument that income is not sufficient. It doesn't override a file showing concerning patterns. It doesn't fill in missing history. It doesn't lower utilization, remove inquiries, or substitute for depth that hasn't been built yet. The people who get denied despite high incomes are not mostly victims of an unfair system. They're applicants whose files have real weaknesses that the salary doesn't fix. Sometimes they know the weaknesses are there and hope the income compensates. Sometimes they've never actually looked at the file with any real attention and genuinely don't know what it shows. Both situations are correctable, but not by applying again and expecting the income to carry it this time. Here's where this lands. Earning well is useful when you apply for credit. It should be, and it is. But the common mental model that a strong salary is the main thing and everything else is secondary is the belief that produces the surprise denials. The issuer is not impressed by your income the way you're impressed by your income. It has a model. The model looks at a complete file. If the rest of the file is strong, the income confirms what the file already says. Solid applicant, low risk, approved. If the rest of the file has problems, the income is just a good number sitting on top of a weak application. That's what a denial usually means. Not that the bank got it wrong. Not that the algorithm is broken. That the file, evaluated honestly, wasn't strong enough for the product, and the salary by itself wasn't enough to change that. A high income is a plus. It is not a golden ticket. And the sooner that distinction is clear, the sooner you can stop focusing on the one thing you're confident about and start looking at everything the file is actually showing. Banks are not approving your self-image, they're approving the file. If the file isn't ready, fix the file.